Thanks for joining today. If you're live, thanks for joining live. Thanks for your patience. If you're seeing the recording, thank you for watching. This is now our usual end of month market view and analysis. What we do is we have a live webinar. It's usually 30 minutes, 45 minutes. We go over our monthly market view report with which we share at the beginning of the month. So with a view of the recent past month. We also share at the beginning of the month on our website, on LinkedIn, and on social media. We share our quant model sectorial and regional allocations. And so the idea is at the beginning of the month, we share the materials, and then at the end of the month, we have this webinar where we share our views, our analysis, and the outlook for markets for the next month and for the next year and for the long term. I'm going to show on screen here the presentations. Let me, before that, I wanted to share with you a little bit of our offices here. Today we're live from Monterrey, Mexico. As you can see from the window, it's a cloudy day. Almost looks and feels like a winter day. And I want to share with you a view of my office. You know, if you know me, you know I love art, so we have a little bit of art here in the office. Family, daughters, son, wife. What I had on screen, the screensaver is the selective index screen, this one here. So that's the MT. So this is our first index, the first index that we created and published together with selective. More than 3 years ago, I think. I think we crossed the 3-year mark already. Maybe it's even 4 years. It's a small and mid-cap index. And if you want to know how to invest, go to our website. And you know, there is a vehicle out there that we put out so that anyone in the market can participate in small and mid caps in a diversified but concentrated strategy. I think it's a very interesting strategy that we've built there. So with that, let me share here my screen. And I'm going to share with you first the monthly market view. And hopefully this is already there on screen. I trust it's there on screen and everyone can see. All right, so this is a monthly market view that we prepared for the month of March. We're looking as a challenging month, definitely. There's all the disclaimer, important information regarding the stuff that we do for clients and for our private funds and listed funds. I'm going right into this before the month of March, and right at the beginning of the second term for President Trump in the U.S., markets were still booming. We can see here, this is the S&P 500 as of the end of February last month, and valuations were also very high. So even though fundamentals were very strong, as we can see on the earnings per share growth expectation on the right, valuations were really, really expensive, more than way above one standard deviation above the historical average. So very challenging markets. even with positive fundamentals from companies. But basically, we had everything set up for at least a mild correction, which we've seen this month of February. It's been a very volatile month. And as we can see here, also very concentrated in the so-called Magnificent Seven, or the mega caps, the large caps in the US, primarily tech names. That's where the outperformance had been concentrated, resulting in a high concentration in the S&P 500 and the Nasdaq as well. And that's exactly where we've seen this mild correction up until now, this month of March. So it's all valuation driven. Yes, we can discuss trade war, tariffs, Ukraine, Russia, the Middle East, but in the end, it's just valuation. Market in particular was very expensive, so any uncertainty, any thing that brings fear to market will result in what we've seen during the month of March. There's a big opportunity outside the mega caps. That's a positive thing. The Magnificent Seven, the mega caps, the S&P 500 is expensive. Still today remains expensive. But outside the larger companies, and particularly outside the US, if we look at Europe, if we look at Japan, if we look even at emerging markets in China, all these markets have rallied during the first quarter and continue performing well this month of March. So that's a real live example as to why diversification matters, why it's important to have diversification in a portfolio, so that we're prepared when these kinds of market situations occur. Having said that, but markets are expensive across the globe. I think we look at several markets, including Germany, Canada, or the US especially. Markets are expensive, but we find very interesting, very attractive valuations in other markets. Japan, I think, is still very, very attractive. The Nordics, we don't have them here, but we'll cover them in some other slides later on in the presentation. But I think there are some very interesting places in the international arena that present very attractive valuation opportunities. And of course, it all hinges on the assumption that we won't have a severe recession globally. And that, of course, we cannot tell. It's impossible to predict. But for sure, the situation that we're seeing right now, geopolitics and the uncertainty that is being created out of primarily what's coming out of the White House, definitely something to watch for, because uncertainty can lead to an economic slowdown just by way of deferring or canceling investment decisions, for example. That's what uncertainty creates in terms of economic outcomes in the real economy. So anyways, year to date, we have the UK, Europe, top performers, Japan underperforming, gold continues a very strong performance, and some currencies there slightly gaining ground against the US dollar, and energy negative. Inflation, as we saw, has slightly picked up in the last reading. So inflation expectations kind of stable, but I think it's also important to monitor what happens here with inflation in the US, in Japan, as we mentioned in the last few months and quarters. It's really what we're seeing there is a normalization the inflation environment in Japan. We see that as a positive reflationary environment. Canada, very similar to what we're seeing in the US. In the US, in terms of monetary policy, we've heard all sorts of conspiracy theories as to what could be happening. That the trade war, tariffs, etc., is a plan to cause a slowdown in the economy that then will trigger a more aggressive rate cuts scenario for the Fed. We don't know. I think those are all theories, opinions. I think what matters is the trajectory of inflation. I think a lot of what we're seeing is inflationary. Definitely going from a globalized environment to a localized environment to protectionism. That's all inflationary. We'll have to see how things evolve over the coming months and years. We are seeing a normalization for sure in monetary policy across the G20, the 20 largest economies of the world. And we can see that in the yield curves across the different central banks. And again, with a very close eye, monitoring very closely what happens in the US economy. As I mentioned, a recession is something that could happen, especially if the uncertainty leads to cancellation or deferral of investment decisions, consumer sentiment. I think those are all important things to monitor. In the meantime, ex-US, Europe, and Japan continue showing strength, good numbers there. The commodity outlook, we recently published our outlook on gold, our outlook on oil. We think oil is stable, basically, going to the bottom line. Oil should be stable. It's basically where it should be, but gold has a lot of potential to continue outperforming given the uncertain environment that we're in. That's basically assessment. If we look at the cost curve for gold, if we go back to our report, which is published and is public, and we can see that information there. It's public information. The gold cost curve is basically $2,000 per ounce of gold. The spot price is right now above 3,000 or around 3,000. So that differential, along with the fact that the trend in gold prices as decoupled from treasuries, indicates that in our view that we're in a very uncertain environment, risk aversion environment. Consumer sentiment, inflation, and economic growth in the US. So as we can see here, the blue line is taking a dive, the blue line on the top chart of the three charts, and that's the consumer confidence. Initial claims not trending higher, that would alarm us, but definitely consumer sentiment is negative. So we need to keep an eye on that. This is another set of charts that we've been reviewing and commenting over the last months. The US outperforming by a lot, and for a long time now, the rest of the world. We can see this compared to Japan, compared to MSCI Europe, world ex-US, and emerging markets. As of the end of last month, we reached the -1 standard deviation below the historical average. So we were really at extremes, and part of what explains the absolute and relative performance of these markets that we've seen this month of March. Same case in Canada, Nordics, the UK, and Australia. Now, going back to the US, if you follow us by now, you know these next 3 or 4 charts are basically the Fed stock valuation model, or basically the relative yields between treasuries, 10-year treasuries, and the S&P 500, and using that analysis as a measure of risk and valuation. Is it expensive? Is it cheap? In this case, the S&P 500. And we start with the expected growth for the S&P. It is slightly above the historical average, so that's positive. MSCI World slightly below, but still within a normal range. 8% expected versus 11% historical. And here, you know, kind of we could use this chart as a try to rationalize why the US has outperformed by so much over the last decade the rest of the markets, but still today we have 2.4% expected growth for the S&P 500, 7.9 for MSCI World. Now, if we go into the comparison or the benchmark, you know, the earnings yield component is what we have reviewed. Now, what is the risk-free yield that we're looking at, and using the 10-year treasuries note for that matter. So first of all, where are yields vis-a-vis inflation, and where they should be, at least relative to the 20-year historical average. So the spread right now is 1.2 above average, and the average 0.3. So this is an indication. I think we could read this as either inflation expectations have come lower, or treasuries and or treasuries are higher than they should be, so rates should be trending down. In general, that's a positive. Now we compare the treasury yield 4.2, where it's now, with the S&P 500 yield, which is the inverse of the price to earnings ratio, basically the same, 4.5 to 4.2. So what this means is investing in, you know, taking the risk of investing in the S&P 500, the largest 500 largest companies in the US, pays you no premium over paying the risk-free 10-year note, or a very small premium, 30 pips. The historical average has been 3.5%. So this is a very alarming statistic. That translates, if everything would stay the same and only change price, this implies a 42% price correction for the S&P 500, 38% price correction for the rest of the world. But of course, it's you know, we're in a dynamic environment. It's never the case that it's just a single variable moving markets. And as we saw, the very basics of the whole model include treasuries, interest rates. Interest rates are very dependent on inflation and inflation expectations, earnings growth, and all these things move. They're dynamic and impossible to predict. So this is one view that says equities are very expensive, or yields are too high, fixed income yields or treasury yields are too high. We contrast that with the ROE. I think what we've seen here, we've mentioned this in the past, the US has expanded its ROE, the corporate America. That's the light blue line here, and decoupling from the rest of the world. So that also explains the premium, the outperformance. But obviously this dip that we're seeing here, ROE for American companies, especially compared to the rest of the world, which are stable, not looking good. So another sign that we should expect a challenging environment for U.S. equities. And then the next I'm gonna, skim through the slides. We go over expected returns based on regression analysis using price to earnings, return on equity, and earnings growth as the independent variables. And we do that across the different developed markets. We're not covering emerging markets in this review. And this is a summary of that view. So even with the challenging conditions that we have today, the U.S. equity market is still showing an 8.5% expected return for the next 12 months, higher than the average for the rest of the markets: Canada, the EU, the Nordics, Japan, Australia, and the UK. We're still seeing a positive outlook, but for sure, single digits, in most cases, low single digits. That's the outlook. So very cautious. We're very cautious right now, especially for the U.S. market, and seeing opportunities in international markets, in the Nordics and in Japan, as I mentioned. Now, very quickly, the second part of the presentation, the Aztlan quant model factors and allocation update. As a reminder, this is the Aztlan quant model. We have, as part of our investment process, we have a 4-step process. The very first step is a quantitative model that we have developed over the years, that is built with several factors, as you can see here on screen: free cash flow, earnings yield, return on equity, earnings yield growth, or earnings growth rather, earnings revision, momentum, liquidity, and earnings estimate surprise. And with these 8 factors, we integrate into a single model and apply this model to the entire investable universe. In this case, what we're seeing here is the small and mid cap section of the investable universe. And as we can see here, free cash flow yield, or the free cash flow factor, is what has worked best. And momentum and liquidity, not so much, right? Momentum negative, liquidity negative. Basically, the liquidity is directly correlated with size. So larger companies performing not as well as smaller companies. This is what this implies. And so we apply that from the bottom up and then aggregate by region, by sector, and overall. And we get, with that analysis, we get this chart, the regional allocations. And so already going into March, the model was reducing North America. NAM is North America. EU, Europe, that's a gold or yellow bar. And then Asia, light gray on top. So I think that's the most relevant piece of information, is the model is moving away from North America. We can see this, even though the 3-month change is positive, the 1-month change is very negative, and the active allocation remains very negative. This is particular to our model and our view of the world. We're underweight, or the model is underweight 23.4% relative in terms of the active allocation for the 1-month change. And positive Europe and Asia. In terms of the sectors, some of the cyclical sectors coming down, some of the more stable, including consumer staples, remain with a high allocation. Financials is the largest allocation here for the model. And we can see here the change in allocations and the resulting active allocations of the Aztlan model. So very overweight financials, discretionary tech, and telecom. Underweight utilities, underweight staples, underweight healthcare. And then for the large caps, we do the exact same exercise, just with a different market cap segment. And by the way, for us, the small to mid is between 500 million to up to 10 billion in market cap. And then the large cap is from 10 billion and higher. So obviously that's a different definition depending on different sources, different investors. Yeah, I could understand and argue, why maybe a small cap is larger than our definition, but that's our internal definition, and just for clarity purposes. And so these are the factor performance metrics for the month and for the year to date, and kind of similar to what we see for the small and mid cap. Liquidity, momentum negative, earnings yield or valuation positive, as well as cash flow. Similar situation, a significant reduction in exposures to the US and to North America in general. You can see that here in terms of the month-to-month and 3-month smoothed average change in allocations, and then just the active allocations that we have here, also underweight North America. And then that's even from the starting point. We're coming into this volatile period in the US market with an underweight positioning there, at least from the point of view of the quant model, the Aztlan quant model. Then finally, sectors, kind of stable, but we're seeing similar situation, reduction in some of the more cyclical names, some of the industrials showing a decrease, stable for financials, decrease in tech, as we can see here in the resulting active allocations. So basically the model pulling away from the tech sector and going into industrial, financials, and energy, consumer discretionary. And that's it. I'll stop sharing right here. We're, I think, right on time, close to 30 minutes of live material. This is or has been recorded or is being recorded. It will be available, and you can look for it on LinkedIn, on our website, and on our YouTube channel. Make a pause here and see if there are any questions or comments. And since I know there's a big delay, I'll just stay here for about a minute, and then if there are no other comments or questions, that's it for today's session. Thanks everyone for joining. See you next month.